All right, everybody. Good afternoon. Welcome back to the Real Perspectives podcast. I'm your co-host here, Vladimir Bosanac, co-founder, publisher of the Registry. I'm joined by my co-host Byron Renfro from Orchard Commercial, and today's very important guest, Jeff Weidell from Northmarq Capital. Gentlemen, hello to both of you.
Good afternoon.
Hello. Thanks for having me.
Byron, as a co-host here, this is our first time doing the show together. I would love for you to say a little bit about, you and your what your firm does, just so our audience has a bit of a sense of where you are and where you're coming from.
Sure. Thank you, Vlad. Appreciate it, and pleasure to be here with you both. So my name is Byron Renfro. I'm with Orchard Commercial. We're the largest privately held property management firm in the Bay Area. We've have our roots dating back 53 years. I've been here for 25 years. You started off at one firm. It was purchased by Northmarq. You became the president of Northmarq in 2013, and then the CEO in 2020. Tell us what Northmarq's all about and kind of how it's changed since you've taken the reins over here.
Sure. Well, and thanks for having me today. Northmarq, we call ourselves a capital markets firm at this point. We started as a mortgage banking company, but today, anything involving the buy, sell, finance decision of commercial real estate we're involved in. We're top 10 in the field. We're one of the very few private ones. Most of our competitors are kind of large publics like a CBRE or a JLL. I like to say we're in the top 10. The top 5 are those big international firms that are public. We're in that second tier, and we're highly focused just on capital markets. We're not in the property management business the way you are. We're not in the leasing business. We're in the finance. We're in the money business, if you will, buying and selling and financing.
And it's worthwhile also saying, Jeff, only in the U.S., correct?
Only in the U.S. Yeah, and people ask about that. That's worthy of another discussion. But we've looked, and the U.S. has the most robust financing market in the world, and the capital comes here. And I'll leave it at that for right now. If we were to expand, it would probably be in the near. Let me restate that when we go back. If we were to expand, it would probably be in areas like Canada or Mexico or somewhere proximate where it made sense from a footprint perspective, but probably not in Europe or Asia at this point.
So kind of if you could just kind of go through the change that have taken
Sure.
place. You've made some acquisitions since you've been the CEO. I think you've gotten into the loan servicing department as well, and talk about that.
Yeah, I guess the easiest way to put it is we probably have a 3-leg stool, and we're kind of adding a 4th leg to become a chair. And by that, it would be the loan servicing, which is about $80 billion strong of loans that we service on behalf of third parties. And that's a recurring revenue business for us, which is helpful, to ride the cycles out. There's a traditional mortgage banking, which is debt origination, and that's been running about $14-15 billion a year in this environment. It was over 20 earlier in this decade. Down a little lower now, but that's a primary platform. And then we obtain as much revenue from the commercial sales business, and by commercial I mean multifamily, retail, industrial, that type of sales. So those are the 3 main business lines. A couple of years ago, we also added an investment fund platform. We bought a company called Morrison Street Capital, which is based on Morrison Street in Portland. We've branded them under our name now. And that's a growing business for us because I always felt we had Northmarq Capital, but we didn't have any capital ourselves to deploy. And we're doing that now. But it's small and it's growing. It'll grow slowly and cautiously. Easiest way to put it.
Yeah,
Gotcha.
Jeff, it's worthwhile sort of highlighting kind of the news in the last, I don't know, maybe 5-6 years or 4 or 5 years around the changing environment of interest rates, and I know we're probably going to get into that a little bit, but I would love for you to also tell us how the firm has evolved and how you're looking at, evolving the firm in general, just from kind of a, point of view of now that, private debt is coming into the market more, and what that means for Northmarq and for your employees.
Well, here's how I view it, and it kind of goes back to your initial question, Byron, about how things changed and how I evolved with the firm. When I started in the business, people kind of liked specialization by individual. If they wanted to know somebody who represented life companies, or they wanted to know a banker, they wanted to know a salesperson, they didn't really like them all wrapped under one umbrella. That's evolved. The business has gotten larger, it's gotten more complex, there are more capital sources. You talk about private capital. They want people who could speak to all of those things when they're trying to make a decision on building, financing, selling a project, bring all those resources to bear. So I think about Northmarq very simply. If our clients want it, we want to get in the space. We don't want to force an ancillary business on somebody, but if I tell them, hey, we're in the business and we have a new fund and it can offer equity to your project, and their eyes kind of light up and say, yeah, that's good for us, that's what we want to do. So I think that's the future for us. Is we're a service business. We follow the trends. We don't make the trends, but we want to be a part of them.
Talk about the fund side of the business, because I think that's, again, it's your newest component. How has that evolved? Where's the capital coming from? What's the capital looking for right now on the fund side, Jeff?
I've learned a few things, and I've learned that what capital's looking for is often not what the market is providing.
Yeah.
So a lot of the capital right now says we'd like to have pref equity at a 12 or 13% yield, and there's simply not a lot of demand for 12 or 13% pref equity today in the market. There's some, but people want lower cost capital.
Yeah, you don't say.
Yeah. Surprise, surprise. But of course, people want to give us money for that space to deploy.
Sure.
So really where we want to play is we're an intermediary. We don't want to compete with our capital sources.
Sure.
We want to fill the niches where there's always a void. And that's kind of where we went into this. It's kind of higher leverage first mortgage loans. It's mezzanine capital, it's pref equity, and it's in bite sizes that are smaller than Wall Street. It's meaning the loans I'm approving, $26 million acquisition, $15 million first mortgage, $6 million mezzanine. Approving the $6 million mezzanine slice. There's always a demand for that, and not a lot of service in the market. But it's a slower growth segment, right? Putting out money, $6 million
Sure.
a crack, is slower growing than buying a $100 million property.
Yeah. So along those lines, where would you say, so it seems like you're filling a need that you see in the marketplace. So what are those areas that are sort of the least desirable, where other people aren't stepping in, where you can fill those needs? You said sort of that smaller market, mezz loans and sort of those bridge funds. Are there any product types that you will look at that others aren't? Or where do you see sort of the areas that are struggling right now, I guess, in the market that maybe you can fill that need?
Well, I think capital tends to congregate with a certain asset class and a certain type of sponsor, right? The more institutional it is, the more infill it is, the newer it is, the easier it is to find the capital. The more you go to a tertiary market, a smaller sponsorship, smaller tenants on industrial. Like I have a deal to approve right now, and I kind of looked at it, and it's kind of cats and dog industrial tenants, not household names. That type of market we can serve, and actually what used to be the Morrison Street team had done a really robust analysis of MSAs across the country, and have kind of targeted the second 25. So not the top tier 25, but 25 to 50 where it's growing.
What's the easiest capital and needs to fill right now? Is that we're seeing AI and data centers. It seems like people are getting into data centers right now that haven't been in that space. And so are you seeing all this capital that wants to be placed in data center? If you've got a data center deal, that's a pretty easy yes. What are some of the other easier markets that you're seeing where, hey, there's plenty of funds here and
Well,
it's really easy
let
to
me
finance?
table the data center one for a second, and we'll
Sure.
go back to that because it's a whole different discussion that we really don't engage in much, and mainly because it's specialty finance and the numbers are huge.
Huge, yeah.
And we talk about that a bit. But really, multifamily had been the golden child for a number of years. Still continues to be strong, but I think it's kind of worn out its welcome to a degree. There are some soft markets. There's over leverage. People have over concentrations. They have loans that haven't been paid off, and they'd like to see those paid off in a market first before they put a new one out. So they're looking more toward, ironically, retail. Retail has performed quite well as an asset class of various sorts. Single tenant, shopping center, entertainment district, all of the above has done quite well. In smaller tenant industrial, for a while it was all big box, and that softened a little bit, and smaller tenant industrial is doing better. I would say office was persona non grata for maybe 4 years, but it's returning because the winners and losers are being defined, and people know which buildings are doing well and which ones aren't. And for the projects that are doing well, we can get financing. But I asked somebody about this today. I said, what's the leverage level on an office deal? And he said 60%.
Gotcha.
So not very high.
And is that only in the strong markets, the San Franciscos, the New Yorks, the tertiary, the secondary markets? Are those still struggling with office? Even if it's the best office in, Salt Lake or somewhere.
I think lenders will do them all over, but it would be very specific to the asset, the sponsor, and the market. Kind of has to be proven that it's performed during the cycle. There continue to be new leases in the market at proper rent levels, etc.
Yeah, this goes back to the question I wanted to ask a minute ago. We've gone through this period in the last 24, 36 months of a lot of workouts and properties selling way under their last price or even assessment values. Where in your kind of mind are we in this process? Are we kind of at the tail end? Is there still a bunch of property out there kind of waiting to go through this? Give us a sense of how you see the market.
That's a good question. I haven't heard somebody ask where we were in this cycle with the refis. I think we're in the middle of it, and I think it's kind of breaking free. For quite a period of time, people wanted to believe that rates were going to lower, and when they watched the short term come down, they wanted to wait even more with the expectation that the 5 and the 10-year Treasury would come down along with it. But now we've kind of reached an inflection point where the short-term rates are relatively stable, the longer-term rates are stable to rising, and there's an acknowledgement that activity has to take place. And it's kind of across the board. It depends on a vintage. If it was a loan originated in 2016, typically it gets repaid and there might even be a cash out component to it and some. If it was originated in 2021, it's coming up short. And that's really what's forcing sale activity. I think if you talk to our sales brokers, almost all the activity today is forced by maturing debt, and that they're coming up way too short and it's time for a sale. So and then back to the acknowledgement, I think it probably helped in the office sector when there was no capital for the sector. Trying to work your way through the problems there wouldn't be effective because there was nobody there. At least now there's capital and there's a price and there is a loan and we're working our way through it.
Yeah. As a quick follow-up, if you were to kind of look at some of these, loans, and bucket them into sort of, 3 areas. What's a no-brainer? What's a maybe, and what's, yeah, that's going to be a tough one to do. And I'm not asking for specifics, but maybe you can give us sort of a sense, from some unknown folks that you work with, right?
Let's start with this. Let's start with a major regional, well-capitalized developer who has a new project, be it multifamily, retail, industrial, call it infill in the Bay Area. It's leased up at current market rates, and all they're looking for is 65% leverage at the best rate, right? We can fill that need very competitively. Okay, so that's kind of easy because it's kind of market priced and it's proven and it has an attractive sponsorship behind it. Property type wise, again, the more you vary from that, the less the strength of the sponsor. And I would say in this cycle, most of the issues emanate from weak sponsorship or problems that exist elsewhere in a portfolio and then spill over to another asset simply because there are no resources to go around. So weaker sponsorship, tertiary markets, and then non-traditional product. Hotels are still difficult because the environment is still difficult by and large. Seniors housing, we kind of like the idea of seniors housing, but it's an operating business, which has a lot of pressures, that's kind of difficult. So anything off the mainstream becomes more of a challenge.
Jeff, as a real estate operating firm, I'm curious about your loan servicing arm, and you came from the mortgage brokerage business for a long time. When you acquired the other leg to the stool here, the loan servicer, what did you learn besides, hey, you already had data on all of the upcoming loan renewals and dates and stuff, but just having a loan servicing company, what else is that? Have you learned something interesting just knowing seeing the operations from the inside now on when leases or loans are coming up for renewal? Any additional data that you've gleaned from that's been helpful for the other lines?
I'll respond to that, and I know you're asking kind of about real estate and markets and intel on that. I'm going to say what we learned is it was critical to our company to kind of ride these cycles to have the recurring revenue.
From the cash flow, yeah.
Just think going back to COVID, our transactional revenue was here, it stopped for 6 weeks, then it skyrocketed for 2 years, and we thought we were making a lot of money. And then rates rose, and it fell to 40% of its prior levels. And if we didn't have the stable recurring revenue of the servicing portfolio, it would have been very difficult to kind of manage the company and retain our staff and keep people around. So for us, we kind of learned the benefit of having that. It's the consistency of capital source has been very beneficial for me in my career, to our clients, etc. And that's what we've learned is that it's hot money comes and goes, but the consistent capital sources kind of endure, just as the consistent borrowers and developers do, right? So I think that's the key, because we, in situations where extensions were required, all the office deals required an extension from the existing lender. It was a smart thing to do. There was no market to take them out, yet the developers were paying. If it was a stable, consistent capital source, they would do that, and it benefited both of them, right?
Yep.
The problems were if the capital source had basically dried up, had transferred hands to a different owner, and demanded repayment.
Yep. And then how would the fund business come in as far as, say, you've got the more variability on the debt side, and then you've got the steady income of the servicing side. How would the fund business come in as far as the fluctuations in cash flow?
Certainly, the desire is the stability of the income. I mean, there are fees for kind of managing the fund annually, and then there's kind of an upside as you kind of harvest gains in various funds over time. So that's the idea. And just so you understand, we grew rapidly. I mean, we're over 1,000 people now.
Yeah.
So we grew rapidly in headcount and rapidly in revenue on the transactional side, whereas the servicing business grows very slowly.
Sure.
So it's a fair question to ask. I mean, part of the reason to get into the fund business is to keep that balance where we're not too heavy transactionally.
Sure. So something I think all the audience members will be interested in is you've been doing this for a long time. You see interest rates at their peak, and we've got sort of a lot of variables in the world right now. There's some inflationary pressure. We've got an incoming Fed chair. What's your take on rates right now? Where are we headed? Give us some speculation here. The Jeff Weidell best here.
So a little backdrop to this. My son works for our company in Los Angeles. I didn't hire him, doesn't work for me. And he just pinged me the other day and he said, "Dad, what's your perspective on rates?"
Something you get all the time, I'm sure.
Did you ever think you would hear those words come out of his mouth? What's your perspective on interest rates?
And if you, this is people will view this, so I won't comment. But no, exactly, advice, good thing.
Yeah.
Perspective is there's nothing really to indicate that rates on the longer end are going to go down. And I've been kind of saying that for a while. If you remember in the teens, 2016, 2017, interest rates were low, and each year we would say they have to rise this year. They're going to go up, and they didn't. And in this cycle, everyone's been saying, oh, they have to go down, and they're not.
Yeah.
There's just kind of a market psychology behind it. But I wrote these rates down right now. SOFR, 350. 2-year Treasury, 406. 5-year Treasury, 423. 10-year Treasury, 63. What do those tell you? Tells you that we have a normal yield curve, upward sloping. SOFR is at a low level. But the longer term keeps rising, and all the pressures in the market kind of indicate, that's normal, and that's what we're operating in. And I know we rely on the MBA's forecasting for the next couple of years. They have the 10-year operating in the mid fours without a lot of movement. So that's kind of the prediction, and it's not terrible. I mean, we've all lived through much higher rates. This is kind of a normal rate range for us.
As a quick follow-up to that, Jeff, and we don't need to get too much into the weeds here, but one of the things that I've kind of noticed is that with heightened immigration, obviously we have, for the first time, I think in U.S. history, a decrease in population. I think a decrease in population means also that you're going to have a decrease in economic output, across the board. At the same time, we have increasing inflation, variables such as, cost of oil and things like that, cost of housing continue to sort of drive inflation up. So you have kind of two forces pulling at the interest rates. At one point, I think if the economy does turn, we're going to have to use that as a tool to sort of help, the economy move. Which one wins, you think, in the medium term?
Wow. I don't know that I'm capable of responding to that. No, you're right. It's a very complicated environment, right? We don't have a clear direction of we're in a robust growth path or we're in a declining zone. There are all these world pressures that are kind of impacting. I think long term, the perspective is we're not talking about our debt. And our debt is very large.
Yeah.
There are worldwide demands for capital. Back to the data center thing, really the biggest impact is the tens of billions of dollars of investment that is going out regularly now into that space. So there's a lot of competing need for capital, and it drives up the cost of debt. So if we have lower rates, we have them lower in the short term to stimulate the economy. But I think the perspective is the longer term rates are higher in general.
And maybe this is a somewhat sort of commercial real estate centric question, but how has the industry worked in are they assuming this is gonna we're gonna have an elevated level of interest rates for the foreseeable future? I imagine they have some assumptions worked into their into their calculations. What are you seeing there?
The general consensus seems to be relative stability where we are. And I would kind of agree with that forecast. Like, we'd be shocked if rates go up 50 basis points, it's probably going to impede the market quite a bit. If they go down 50 basis points, the market will accelerate. We're in a relatively stable environment for rates now, probably for the reason you just said. There are kind of conflicting messages in the economy as to the direction we're heading. I mean, on one hand, we see all this investment in AI and efficiency gains, and the economy continues to be robust. On the other hand, there are kind of these world issues and issues with employment in certain sectors. So it's not clear. So stable is okay. Ironically, a lot of companies can make money in this rate environment. When rates are too low, it's hard for those who rely upon interest income, think life insurance companies and certain banks, to make earnings. This is a comfortable range to operate it.
What about any comments on the incoming Fed? Do you think they'll lower rates or have any much effect on that, or just it's there's too many other things going on that will affect that?
From everything I've heard, is it's very unusual for a new Fed chair to make dramatic moves unless the market's been signaling that, right? Mm-hmm. That's the mandate to come in. So I think the presumption is a little bit of a wait and see as he enters, and then probably build some consensus on direction.
So going from one sort of forecasting thing to another here, I'd love to get your thoughts on the privatizing of Fannie Mae and Freddie Mac. That's been floated around Washington here for a little while. What have you heard? How do you think it affects the multifamily market if that does happen?
Well, they were private at one point. They were never intended to be wholly owned by the government, and here they are since 2008. I mean, we'll be going on 20 years of government ownership, and I think long term they belong independent, right, with some form of backing. But there's the way it operates. They're actually making money for the federal government right now, and they do consistently,
Yeah.
particularly on the multifamily side. It's a robust program, so there's little incentive to make dramatic change kind of in Washington. So the process is slowed down, and that's a good thing. First, the kind of do no harm to housing, it has become the mandate there. In terms of privatization, I would just hope that there isn't a major change in the program, because it seems to work. I think they fill between, on the multifamily side, 35 to 40% of the market. And most importantly, it's kind of stable liquidity and it's consistent underwriting. And we all know that other institutions can kind of fill that void somewhere, but they go hot and cold at the same time. And the beauty of having the agencies is they underwrite at a certain range with a certain return consistently through cycles, and I think that's proven beneficial. And it's our hope they wouldn't change that much. And we haven't heard anything to indicate that's the desire. Actually, it's been more on the balance sheet side, meaning if we move this off the Fed's balance sheet, can we make some money in privatizing it, right? Rather than really changing the program.
Yep. Appreciate your thoughts on that. Thank you. I wanted to bring it back to data centers here and understand that the the cost of developing these data centers and the scale is just phenomenal. It's something we haven't seen before. I think we recently saw Brookfield acquired a couple data centers in Moffett Park here in the Bay Area. Those were more traditional, smaller scale. I think those were strategic buys. Brookfield was getting into the market for the first time. Is that something that Northmarq would handle, or is that just not in your sort of zone and product type, and others handle the data center market?
Data center is pretty specialized. We've occasionally done a deal here or a deal there, but it's not really in our wheelhouse. I'll give you some numbers and kind of the reason why. And you're right, there was kind of the traditional data center, and its growth curve was 15-20% a year, as I understand it. But the money is all going to the hyperscalers, and it's a handful of household names. So Amazon, Google, Meta, Microsoft, I wrote down these numbers from a report, $150 billion committed to data centers in 2023, $400 billion committed in 2025. A report I just got now is a commitment of $656 billion toward new data centers in 2026. The whole U.S. commercial mortgage industry annually is somewhere around there for all property types.
Wow.
And I'm not sure that's all going out annually, but just to put it in context, it's more about the capital demands in the industry and how people want to allocate it, and whether it's real estate or an investment in that. And the way they're making it into real estate is by creating a synthetic lease, right? We'll create a box, we'll call it real estate holding company. Google will lease it on a 15-year lease, and then we'll finance the building with a Google 15-year lease and finance it out in that direction. That's kind of one method of doing this. But the numbers are so big, no single institution would take that risk. It has to be kind of a Wall Street type security.
Yeah. Interesting. I think we saw that a similar type run up, but not on that scale on the life science, when we saw the life science cost to build out buildings. But again, that was still a product type and something that was more known versus the scale that we're seeing on the hypercenters. That's pretty incredible. And
just a comment on that in the economy. Again, I follow on the MBA board, and their economist says that fully half of the GDP going on in the United States right now is driven by this data center construction and related. Right?
Wow.
That's incredible.
Yeah.
Yeah. I'm also curious, given that you do so much with, multifamily, are you beginning to see, and maybe it's too early, but I'm curious if we're going to, experience increase in, cost of, electricity and power, if those are going to start working its way into the pro formas. Is that something that's already beginning to kind of rear its ugly head, or you haven't seen it quite yet?
Well, we saw it a couple of years ago. I mean, we saw the increases in energy prices kind of across the board, as well as insurance impacting everyone. And that seemed to be a kind of couple year run of inflation, which is now stabilized. In terms of the impact of data centers on that, we haven't seen that yet. I think that's the big question. And it's why most of these hyperscalers are looking to distant locations to try to get power off the grid or self-generated, because they know residents don't want higher energy prices because they move in.
Yeah.
Right. And I think the cynic in me will also say it's probably easier to, persuade somebody in a very rural region and throw a couple of $1 million their way towards their little community versus, coming into an urban center where it's really going to make an impact. You're going to have people screaming, right, not to have this thing built there.
Yeah, I mean, I think all's true, and there's also this issue of latency. We're going down a detailed avenue here, but
right.
I also have a son who kind of works in the technology business, and I hadn't thought about this. And there are certain communications, like in robotic cars, that are transmitting data, and there can be zero latency in the decisions, right, in terms of the movement of the car and what it's doing. So that type of interaction has to be housed very near
Yes.
the environment. But there are other things that are going on with AI that really don't need to be nearby and can work remotely, which is probably a good use for something in a very rural area with its own power generation, et cetera. But it's a new era for all of this in a big way.
You mentioned that in the U.S. we have capital coming in. That was one of the first things that you said when we started the interview. Are you noticing allocations of capital that previously would have gone to maybe things like office or multifamily or even industrial, now going into data centers, where it's impacting perhaps some of the fundraising on your side?
I wish I could really comment on that. It's been pretty stable in that regard. I think we went through this whole tariff discussion last year, and I think that kind of impeded capital flows for a bit, or changes of allocations. But I think it's fair to say that given just what I described in terms of the capital need for data centers, it's having an impact of allocations as to where people want to invest, and should a portion of the real estate investment or investment in America go there. I'm sure the answer is yes, right? It is.
Coming back to sort of a more familiar product type, maybe that to some of us, life science. Did Northmarq participate in a lot of life science lending, and how is that? We saw that industry really be hit after post COVID and slow down a lot. A lot of life science buildings being converted to either office or advanced manufacturing, or discussions of that. How does Northmarq view the life science market? Have you lent money on that? What's your perspective?
Yeah, you're kind of going 0 for 2 on product types.
No, understand.
And I will
That's
say,
okay.
well, and part of it is, as you know, life science is really concentrated in less than a handful of markets in the United States, right? Sure. In terms of the Bay Area and Boston and San Diego, and a little bit outside of that. And it too is a highly specialized environment. We weren't heavily involved in that, is the easiest way to put it.
Probably a good thing.
It's always been kind of a niche play for the money sources, right? So to the extent we worked with a life insurance company who wanted to invest in real estate, they would do a life science deal if it was backed by a credit lease in a certain layer. But to the extent it wasn't, tended not to be involved. So kind of beneficial to us.
Yeah.
Byron, I think what Jeff is trying to tell us is that he'd like to stay in the boring part of the business.
Yeah.
Let's
let's talk about the bread and butter here. So what's Northmarq look like in 5 to 10 years here? You've kind of added this fourth leg
you're in the
here.
wheelhouse. My comment back to that is we're in the closed deal business, right? We get paid when deals close, so we try to find the things that work in the environment.
For sure.
We all are. I really want to be twice as big as we are, and we have room to grow. It's kind of, as I mentioned previously, we're competing in the top 10, but the top 5 are that much bigger than us, and we have an opportunity. And it probably doesn't involve us getting into many different areas in the space, but it makes us become bigger. I mean, can we have a specialty team in data centers? Potentially, right, as that market grows out. Sure. We certainly don't have a big presence in the industrial market. We kind of want to build our opportunity there, because that's going to be a part of our business for a long time. We're solid in multifamily. There are always opportunities to grow there. So kind of think by product types, we can get larger. And certainly in the fund space, we can grow that platform. We're also doing something that's kind of a hybrid right now. As you may ask this question about private equity. Private equity has kind of started in private debt funds on the larger deal space, and they don't really have the staff to cover let's call it $25 million loans across the country. So we're entering in ventures with them to effectively deploy and service that capital on their behalf, which is somewhere in between just being an intermediary and actually being an advisor in the fund. And we see more opportunity for that.
Yeah, it kind of speaks to your point that you're playing in sort of the markets where you see a need, and you see sort of the private equity groups servicing the larger market, but bringing that down and being able to service the requirements that the traditional banks and life insurance companies aren't servicing and involve your fund. I think that's a great strategy here.
Yeah, and our key is to find a structure where everybody makes money in it. Right. I mean, the reason the reason they don't want to build a staff to serve that market is it's naturally more expensive to deploy that. Right. So we could be more efficient in doing that and still make money for their investors and have a product that people want to borrow.
So you've been doing this again for 40 years at the same company, essentially. Where are you finding new talent? People tend to shift jobs more frequently these days. Where are you recruiting from? How do you recruit? How are you going to double the size of Northmarq over the next 5 to 10 years and finding the right talent?
Our best help has always come the same way. It's kind of, I hate to say it's walked in the door, but recruiting has tended not to work as much as referrals. And people related to the business and people who sense an opportunity, or somebody like you who recommends somebody who might be good for us, and we've grown them. So we do a little of both. I like to think of it kind of like a baseball team. I mean, we do some external recruiting of talent, people shifting from another company, and typically because something's happened there and they're not satisfied, and we could offer a better environment for them here. And we have homegrown talent, right? And as a matter of fact, next week we have what we call our associates coming to Minnesota. We do have a program, 2-year program. It's tough to start in the business, so we kind of build a bridge. We used to call it a mentorship. That was like too heavy of a word. I think it's more kind of a coach. And we found we actually had to incentivize the coaches to do this as well, which only makes sense, right? I mean, everyone has a day job and they're all busy. They want to help somebody else, but they're much more willing to engage with somebody if you kind of put them on a team and there's a little financial benefit to doing so. So we do that for a couple of years, and and it's still hard to grow into the business, but I think our success rate with that is far higher than if we had no program.
Jeff, have you had success at bringing people from kind of across the country, or do you see that growth kind of happening more in some of the more traditional kind of, urban centers, big cities like obviously LA, Chicago, New York, right? West Coast, right? Where do you think that talent is going to land?
It's still driven regionally where young people want to live.
Fun cities.
Yeah, I mean, fun cities, fun environment, and dare I say, it's much easier to grow talent in an office with an already strong team, just because the environment is kind of that culture, and just simply by interacting in that environment, people learn better than being in a smaller environment and maybe a sleepier office. So it's our goal, as a company to kind of bring that together, and at least people who might be, we have a very good office in Omaha, that somebody in Omaha could learn from our Dallas people, and in Texas they're real estate crazy. We do lots of deals. Hopefully share in that.
And I'll ask my final question here, and I'll let Byron kind of close off the conversation here. But as you look at sort of things that makes somebody successful in your business, have those values, have those qualities changed over the time that you've been there, or since you've been leading the organization? Do you need more sort of tech savvy people, more people kind of deal, right? What are the things that really make somebody stand out, you think?
Ironically, I don't think it's changed. I think the tools have changed. I think, what you need to bring to your client base has changed, and obviously you have to change with it, but the skill sets are kind of the same. Kind of goes back to what I'm saying. We're really in the service business, and we're in the service business to the real estate industry as a whole, and we have to adapt to it. And in that broad skill set is figuring out what you need to know, how you can translate that to your clients, and being consistent and persistent in doing so. And it's a little different for everyone, and it's also a little different market to market. What works in the Bay Area is a little different than what works in Texas, even today, right? But the skill sets are consistent. Probably the biggest change, we can talk about AI and things, is more in the junior ranks, right? It's more in the processing and in the data side. I mean, we have a surplus of data. We have a surplus of information that flows today that we didn't have before. So the skill set more today is understanding how to codify that and make it useful than it is just obtaining it, right?
I was going to ask you what advice you'd have for young people entering this field, and I think you just have provided us in a lot of ways for that. I'm amazed at the use of technology that young people have. Right, for our AI team, they've got to be under 25 because they just look at things differently than any of us do. No matter how much we try to use AI and advanced tools, but it's pretty amazing. So, anything new and different that Northmarq's doing using AI within Northmarq you mentioned so much data out there, how you process that, any applications of AI that you're using as a
I wish
company?
everybody likes the shiny penny on that and wants a little bit of sizzle, and I'll kind of disappoint you there. We've been doing a lot of trials in different places.
Yeah.
And there are certain things like lease reviews, like we've been able to utilize AI very quickly to kind of take copious amounts of information, highlight pretty boring stuff.
Sure.
But I would say our tech group would say the last 6 months has seen really material progress in terms of probably impacting workflow in this area. I mean, it's starting to come where you can populate spreadsheets with information, and we could create maybe broker opinions of value with kind of very little input, right?
Sure.
So I guess my answer there is wait a year.
Yep.
I think we're going to have some tangible progress.
Yeah.
Really.
Agree.
And it's been a lot of talk and kind of fun stuff to this point, but the tangible progress feels like it's coming quickly.
Yeah, definitely.
It's beginning to hit the road here.
Well, Jeff, thank you so much for taking the time to chat with us. Really appreciate it. Byron, thank you also for joining in this interview. Gentlemen, have a good rest of the day, and we'll be in touch soon.
Thanks for having me.
Thank you, Jeff. Really appreciate it.